compared to last year. Joining us now is Douglas Holtz-Eakin, former chief economist of the President's Council of Economic Advisors. Douglas, thanks for joining us on this. Appreciate it. So inflation, the ideal number you want to be at is 2%. We're not quite there yet, but almost. And certainly I don't think many people predicted we would be here in this moment, markets rallying the way that they are, the economy doing as well as it is, avoiding a recession that was predicted.
Yeah, I think there's been a lot of good news in 2023, and certainly the disinflation's been more rapid and less painful than anyone had anticipated. That's all great news. The stock market rally is really predicated on the notion that the Fed's going to be in cutting soon. Mortgage rates have made the same move. My only caution is that the Fed's preferred measure of inflation peaked at 5.6%, and now it's down to 3.2 year over year. So that's 2/3 of the way to the target of 2%, and it took nearly 2 years to do that. So we're not going to see inflation back to normal overnight. We're not going to see the Fed cutting rates overnight. We have a little bit of a haul left before we get down to the target, and I have some caution about the outlook based on that.
Do you think it's unlikely? I know Fed Chair Jerome Powell has said we might see 2 to 3 cuts over the next year or so for interest rates, obviously reaching an all-time high to kind of quiet down, slow down inflation. You think it's unlikely we're going to see that many cuts over the next year?
We may see rate cuts, but the question is, why do we see rate cuts? My concern about the outlook really focuses on the business sector. The household sector has carried the economy in the second half of 2023. Business investment has been dead flat. In the post-war period, every recession has been led by a downturn in business investment. The only exception is the pandemic recession. So to have a really weak business sector is a concern. And if the Fed is cutting because the economy is starting to fall off a cliff, that's different than if the Fed is cutting because inflation is back to 2% and we're growing strongly. So the real issue is, will we get balanced growth, households plus businesses, or are we going to have this unbalanced growth we've seen in the second half of this year?
So when you talk about balance, I also wonder about the feels and the reals. And what I mean by that is what we're seeing in the economy, right? The numbers where the economy is pretty healthy and doing pretty well, right? And then the feels of the American people, many of which don't feel as if the economy is doing as well. They still see kind of grocery prices not necessarily being where they want to be. Do you think that's going to line up this year now more than ever?
Well, there were 2 years, 2021, 2022, when inflation badly outstripped wage growth, and people were at work and getting further behind. Now, that changed in the second half of 2023, and the issue is, will that make up for those 2 years, which I think really hurt consumer confidence? Will we turn a corner on that front? That's what we're facing going forward. And think about the Christmas season. People are very happy. Sales are up 3% from last year, but we have 3% inflation. So people aren't buying more stuff. They're just spending more to keep up with the inflation. That doesn't make people very happy.
Douglas Holtz-Eakin, thank you so much, sir. Appreciate it. And happy early New Year to you.